Hello and welcome back to the QuantScore Financial Show, your go-to source for cutting-edge market analysis and data-driven investing insights. Whether you're a seasoned trader, a curious investor, or just someone who wants to understand the numbers behind the headlines, you're in the right place. Here we break down the market using cold, hard data. No hype, no speculation, just the facts and figures that matter most. Our team dives deep into the numbers, analyzing trends and patterns that most people overlook. Remember, this video is not financial advice. Our goal is to educate and empower you by sharing a transparent look at the numbers and strategies that drive the market. Always do your own research and consult a professional before making investment decisions. Our mission is to pull back the curtain on quantitative trading and share what our algorithmic models reveal. We use advanced analytics and machine learning to uncover insights that can help you make smarter decisions. This week we have a small treat of extra stocks, examine 12 companies rather than our normal 10. This week choosing to evaluate the quant score and data of 6 undervalued and 6 overvalued as identified by our models using data through Thursday, July 3rd, 2025, due to the 4-day holiday market week in celebration of 4th of July. Join us as we explore these corporate creatures and the numbers that define their place in the market now. Let's begin our journey. Our journey into the realm of undervalued tech giants begins in the heart of China with Baidu. We are setting our sights on a company that has become an integral part of the digital lives of billions. Often called the Google of China, Baidu isn't just a search engine. It's a gateway to the vast Chinese internet landscape. It's a household name synonymous with online information and services. Baidu dominates search, yes, but its ambitions stretch far beyond. It's a powerhouse in AI, pushing the boundaries of what's possible with artificial intelligence. And it's a major player in the rapidly evolving world of autonomous driving, investing heavily in the future of transportation. Baidu's Apollo program is at the forefront of this revolution. Yet, despite its dominance and future-forward investments, our models detect a significant undervaluation. We believe the market is overlooking something crucial. Despite robust revenues consistently demonstrating its ability to generate substantial income, and a market cap in the tens of billions reflecting its significant size and influence, recent sentiment, influenced by global economic uncertainties, and regulatory pressures specific to the Chinese tech sector have, in our view, unfairly left Baidu overlooked and undervalued by the broader investment community. Starting out our list this week, Baidu clocks in at a quant score of 11, signaling strong financial health and indicating there is considerable room for future growth. Baidu's low price-to-earning ratios, especially when compared to its international peers, are nearly incomparable, with a forward price-to-earnings ratio currently sitting at 9.26. Plus, with heavy investments in AI and a commitment to future technologies that distinguish it from the competition, this strongly suggests long-term potential the market does not seem to be factoring in, creating an extremely unique investment opportunity for risk-taking investors. Baidu trades at a discount to American tech peers. Despite operating in a massive and growing market, a mispricing our models flag as a significant opportunity for discerning investors. Billions invested in autonomous driving, positioning Baidu to capitalize on the future of mobility and generative AI, a field with immense potential for innovation and disruption, position Baidu for future dominance in the tech landscape, both in China and potentially globally. The market's short-term focus, driven by immediate concerns and anxieties, misses Baidu's strategic vision, a long-term plan that extends beyond quarterly earnings and resources, the vast financial and technological assets it can deploy to achieve its goals. Our quantitative lens sees Baidu not as a struggling entity, but as a giant resting in the shade. Undervalued, yes, but also poised for a comeback, with strength ready to re-emerge and reclaim its position as a leader in the global tech arena. Watch this one closely for a potential resurgence. It could be a rewarding journey. Next, we turn our attention to United Parcel Service, or more commonly known by its ticker symbol UPS. This company truly represents the backbone of global logistics, facilitating the movement of goods across continents and connecting businesses to consumers worldwide. It's a critical component of the global economy. Despite its iconic presence, a brand recognized globally, and its century-long dominance in the packaged delivery sector, our valuation models indicate a potential undervaluation. We believe the market may be overlooking some key aspects of UPS's business. Currently, UPS trades at a discount when compared to its historical averages, presenting a possible entry point for investors. The company also boasts a strong dividend yield, offering income to shareholders and a fortress-like balance sheet, providing financial stability and flexibility. Our quant score for UPS is a strong 15, reflecting its overall solid financial health and potential. It seems the market is primarily fixated on short-term challenges such as labor negotiations and fluctuating fuel costs, which are undoubtedly factors to consider. However, we believe the market is underestimating UPS's significant tailwinds from the continued growth of e-commerce. Furthermore, the company's vast operational scale provides a competitive advantage that is difficult to replicate. UPS's extensive infrastructure and logistical network create a significant moat, a barrier to entry that few competitors can realistically challenge. Our comprehensive analysis suggests that the market's current sentiment is overly pessimistic regarding these short-term headwinds facing UPS. Looking ahead, the long-term trend toward increased e-commerce activity remains a powerful and sustained force driving growth in the package delivery industry. In our view, UPS represents a classic case of the market missing the forest for the trees, focusing too much on temporary setbacks and not enough on the bigger picture. Therefore, its current stock price potentially offers significant value for investors who are willing to exercise patience and look beyond the immediate concerns. Next, we enter the healthcare sector with Humana, ticker symbol HUM, a leader in Medicare Advantage. Despite regulatory changes and rising costs, Humana's fundamentals remain strong, explaining their quant score this week of 19. The aging US population is a powerful tailwind, and Humana's expertise in senior care is a major advantage. Market anxiety over short-term cost inflation has created a valuation gap. Our models see stabilization ahead, with Humana's long-term value underappreciated. The company's history of navigating healthcare policy is a key strength. Humana is being penalized for sector uncertainty, not its own performance. For long-term investors, this is an attractive entry point. Humana's role in society and its fundamentals make it a standout. Next up on our list of undervalued stocks following the July 4th holiday weekend, we have Walgreens Boots Alliance, an old giant, a name synonymous with neighborhood pharmacies and trusted healthcare advice. For generations, Walgreens has been a cornerstone of communities, offering everything from prescriptions to everyday essentials. But now this titan is wounded, facing fierce competition from online pharmacies and the ever-expanding digital marketplace. The convenience and cost-effectiveness of online retailers are challenging Walgreens' traditional business model, and adding to its woes are significant legal challenges, ranging from medication-related lawsuits to disputes over healthcare regulations. These legal battles cast a shadow over the company's future and add to investor uncertainty. Consequently, its stock has plummeted, reflecting the market's growing concerns about its long-term viability. Investors have been selling off shares, driving the stock price down to levels not seen in years, currently trading at a forward price-to-earnings ratio of 7.35. But despite these challenges, our models see potential in its ongoing transformation. Walgreens is actively working to adapt to the changing landscape, exploring new strategies and initiatives to revitalize its business. Our proprietary quant score scored Walgreens this week at 20, suggesting underlying strengths that the market may be overlooking. Walgreens is strategically shifting its focus from a traditional retail pharmacy model to a more comprehensive healthcare services provider, offering a wider range of medical solutions and personalized care. This pivot leverages its vast footprint of stores across the nation, providing convenient access to healthcare for millions of Americans. The market is currently pricing it for extinction, seemingly discounting its potential for recovery and future growth. However, its tangible book value and low valuation multiples suggest that the market's pessimism may be overdone, creating a potential value opportunity. The dividend yield remains substantial, offering investors a significant income stream while they wait for the company to turn around. This strong dividend payout signals management's confidence in the company's ability to generate cash flow and sustain its financial commitments. Our analysis finds a level of cash flow stability that appears to be overlooked by the market's current negative sentiment. Walgreens represents a high-risk, high-reward investment opportunity, a company actively fighting to reinvent itself and adapt to the evolving healthcare landscape. The market has largely written it off, focusing on the challenges and overlooking the potential for a successful turnaround. But our models see a compelling opportunity in the current discount, suggesting that the stock may be significantly undervalued. Its valuable real estate portfolio and strategic pivot towards healthcare services, including partnerships like VillageMD, could unlock significant value for shareholders. Investing in Walgreens is undoubtedly a risky bet, but it's not without considerable merit, offering the potential for substantial returns if the company's transformation efforts prove successful. Next up on our list of undervalued stocks this week, we have United Health Group Incorporated, ticker symbol UNH, a healthcare leviathan integrating insurance and services at massive scale. Despite recent regulatory and cost headwinds and a year that has been nothing but an absolute shock to the company and the healthcare industry. As a while, our models still see a rare undervaluation after the catastrophic crash the stock has seen. For this week, United Health's metrics came in with a QuantScore of 22. Their Optum division and data-driven efficiency are simply unmatched, and the market's focus on short-term medical costs completely misses United Health's pricing power and operational excellence. Their ability to manage risk through data is a key survival trait. Recent price weakness is likely temporary, with United Health being an apex predator, adaptable, powerful, and currently underpriced. Our analysis sees this as a rare opportunity to buy quality at a discount, currently trading at a remarkably low price-to-earnings growth ratio of 0.82. United Health's dominance is not fully reflected in its current price, and that is why it is the second highest on our list of undervalued stocks this week. Enphase Energy, ticker symbol ENPH, is a leader in solar microinverters and energy management and is our final undervalued pick, making it our greatest undervalued opportunity of the week according to our QuantScore. The company's fortunes have dipped with the solar market slowdown, but its technology and financials remain strong. Their QuantScore for the week, an electrifying 30. Enphase's asset-light model and healthy balance sheet are key strengths. The downturn is cyclical, not structural. Demand for solar will rebound as rates stabilize. The market's herd mentality has punished Enphase unfairly. Long-term trends in electrification and renewables favor Enphase. Its expanding ecosystem, including batteries and EV chargers, positions it for future growth. Our models see Enphase as a specialist temporarily out of favor. The current price is a buying opportunity for patient investors. Now that we have finalized our picks for our undervalued stocks of the week, we shift to overvalued territory with our first stock, Ryan Specialty Group, ticker symbol RYAN, a leader in specialty insurance. The company's expertise commands high margins, but the market's enthusiasm has pushed its valuation to extremes. Ryan is starting our overvalued list this week with a QuantScore of 24. Valuation multiples are at historic highs, leaving little room for error. The market assumes flawless execution and ignores cyclical risks in specialty insurance. Any economic slowdown or shift in the insurance cycle could pressure growth. The stock price reflects optimism that our models can't justify. Ryan Specialty is a quality operator, but the price is too steep. The risk-reward profile is skewed. Caution is warranted. Our analysis flags this as a clear case of overvaluation. Second up for our overvalued stocks this week, we have International Business Machines, better known by their ticker symbol IBM. IBM is a tech veteran reinventing itself around hybrid cloud computing and artificial intelligence. Recent stock gains are driven by AI hype, but growth remains modest. IBM's metrics have tested. Our algorithms have found their QuantScore this week to be 25. IBM trades at multiples similar to faster-growing peers, despite lagging revenue growth. The market is paying a premium for a narrative voiced by Jensen Huang and NVIDIA, and not yet matched by any current results. Legacy businesses still drag on performance. Consulting is strong but lower margin than software. Our models see IBM valued as a high-growth tech, but its fundamentals say otherwise, with the worst metric we see this week being a 40% decline in quarterly earnings. The current price is built on optimism, not reality. IBM is overvalued relative to its true growth prospects. Agnico Eagle Mines Limited, ticker symbol AEM, is a senior gold producer, and its stock has soared with the increases in gold prices. Coming in this week at a QuantScore of 28, trading at a premium to actual value, assuming ever higher gold prices, always hoping to fall back on simpler times to the gold standard. Mining is capital intensive and highly sensitive to gold's volatility. Investors have crowded into Agnico as a safe haven, pushing valuation to risky levels. A gold prices dip, the stock could fall sharply. The market is ignoring the asymmetric risk. And with the company currently trading at a price-to-earnings growth ratio of 28.15, there is simply no more room to grow at that point, meaning the only direction is down. Agnico is a quality operator, but its fate is tied to a single unpredictable factor. The current price leaves no room for disappointment. Our models warn that optimism here is dangerous. All of this is to explain why Agnico is easily on our overvalued stocks list this week. Vistra Energy Corp, ticker symbol VST, is a major US power producer whose stock has been fully charged on AI-driven electricity demand. Currently trading at a ridiculous price-to-earnings growth ratio of 6, easily explaining our algorithms labeling them as overvalued with a quant score of 43. The stock's meteoric rise is fueled by the data center narrative, but valuation is now extreme. Vistra trades at multiples far above its history and peers with the market, extrapolating current trends into infinity, ignoring any cyclical risks by our commodity prices. Weather and regulations still matter, but the current price discounts are mismanaged, focusing only on AI upside. Vistra is strategically positioned, but the market's reaction is overblown. Fundamentals have been left behind. Our analysis sees Vistra as precariously overvalued. Fourth up for our overvalued stocks, we have Applovin Corp, ticker symbol APP, a mobile app platform who has seen its stock skyrocket on AI and ad tech momentum. Their quant score this week a circuit-breaking 43, with strong revenue and margins, but valuation is detached from fundamentals. Price to earnings and growth ratios are at unsustainable levels. The market is pricing in perfection and endless growth. Mobile gaming and advertising are highly cyclical and competitive. The current price leaves no margin for error. Applovin is a strong competitor, but not invincible. Our models see a classic momentum bubble. The risk of a sharp correction is high. Palantir, a data analytics firm with roots in defense, is our most overvalued pick, coming in with the highest quant score of the week at an insane 50. The stock is driven by narrative and AI hype, not financial performance. Adjusted for stock-based compensation, profitability has been unclear. Valuation is extreme, even for high-growth software, while currently valued at a price-to-earnings ratio of 584.17. The market is betting on Palantir becoming essential to every enterprise. A risky assumption, given a price-to-earnings growth ratio of 4.26, definitely over the hopeful goal of 1. Competition and long sales cycles are real challenges. The price reflects dreams, not reality. Our models see Palantir as dangerously overvalued, with the market overvaluing expectations. As our expedition ends, we've seen undervalued giants and overhyped favorites. The digital savannah is ever-changing. Perception and reality often clash. Our goal: to offer a quantitative lens for clearer market insight. Continue your own exploration, question the narrative, and stay curious. Join us next week for more QuantScore analysis. Subscribe for weekly insights into quantitative trading. Which company fascinated you most? Which company do you completely disagree with our valuation? Share your thoughts below. Thank you so much for watching, and until next time, stay calculating, my friends.